For many years, Thrivent operated a member-owned credit union called Thrivent Federal Credit Union. But in 2023, that institution was converted into a bank, now known as Thrivent Bank. At first glance, that sounds like a major philosophical shift, because credit unions and banks operate under very different structures. Credit unions are nonprofit cooperatives owned by members, while banks are for-profit financial institutions owned by shareholders or a parent organization. So why make the switch? The main reason was flexibility and scale. Credit unions operate under certain regulatory limits that can restrict growth. For example, they have tighter rules around business lending, membership eligibility, and how much capital they can raise. As Thrivent expanded its broader financial services platform, including insurance, investments, and financial planning, those limitations made it harder to integrate banking products into its long-term strategy. By converting to a bank structure, Thrivent gained greater freedom to expand lending, offer a broader range of financial products, and invest more heavily in technology and digital banking services. It also allowed the organization to align its banking operations more closely with its national financial advisory network. Another factor was membership restrictions. Credit unions must define a field of membership, meaning only certain groups of people can join. A bank structure allows the institution to serve customers nationwide without the same eligibility constraints. Thrivent emphasized that the conversion was intended to support growth and better serve members with integrated financial solutions, things like checking accounts, mortgages, savings products, and lending that fit alongside their insurance and investment services. From a regulatory standpoint, the accounts remained federally insured, just through a different system. Credit unions are insured by the National Credit Union Administration, while banks are insured by the Federal Deposit Insurance Corporation. So deposit protection levels for customers stayed essentially the same. What didn't change was Thrivent's broader mission. The organization still positions itself as a purpose-driven financial services provider, serving people of faith with charitable programs and member benefits tied to that identity. In simple terms, Thrivent converted its credit union into a bank primarily to gain regulatory flexibility, expand services, and support long-term growth, while continuing to integrate banking into its larger financial planning ecosystem.